So what if I told you that you can save yourself thousands, lakhs or even crores of rupees of loss in stock market just by looking at some of the basic parameters or ratios or factors of a particular stock before investing your hard-earned money in it? Wouldn't that be a lifesaver? Exactly. So in today's video, we are going to discuss about some of the very key ratios or factors that we need to consider before we make our decision whether to invest in a particular company or not. Because when we buy a share of a company, we become a part owner of it. No matter if you own a 0.0001% of the company, we are still the owners of it and we want to be an owner of the best companies. So without wasting any further time, let's get started. So the number one factor we need to consider is return on equity. Return on equity measures a company's ability to generate earnings in relation to its shareholders' equity. ROE is expressed as a percentage, and this financial ratio indicates how much profit is generated by the company for each rupee of the shareholders' equity. You can calculate ROE by dividing net income by shareholders' equity and then multiplying by 100. So what is a good ROE? While averages can vary depending upon the industry, an ROE of about 10% is generally considered good. A higher number is better as it indicates that the company can generate more income from each rupee of shareholders' equity. For example, here we can see that the ROE of HUL is 20%, which can be considered as a decent number. Number 2 ratio is operating profit margin. The operating profit margin is one of the most useful ratios to evaluate a company's profitability. Like ROE, it is also expressed as a percentage and it measures a company's earnings in relation to its revenue. In other words, it indicates how much profit is earned from each rupee of sales. We can calculate operating profit margin by dividing profit, also called as net income, by revenue, which is also called as net sales, and then multiplying it by 100. So what is a good OPM? For OPM, a higher number is better as it indicates that the company makes more profit on each sale. The averages vary significantly between industries, but generally speaking, a profit margin of 5% is low, 10% is average, and 20% is good. For example, here we can see that the ROE of Hindustan Unilever is 23%, which is again a good number. Number 3 ratio is current ratio. Also called as working capital ratio, the current ratio measures a company's ability to cover its current liabilities, for example, debts due within 1 year, by using its current assets. Expressed as a numerical value, this important financial ratio indicates how many times current liabilities can be covered by current assets of the company. The current ratio is calculated by dividing current assets by current liabilities of the company. So what exactly is a good current ratio? Since industry averages can vary and current ratios can fluctuate, it's difficult to set a benchmark for what a good current ratio is. However, a ratio above 1 indicates that the company has more current asset than current liabilities, whereas a ratio below 1 indicates that the company has more current liabilities than the current assets. For example, here we can see that the current ratio of Adani Enterprises is 0.83, which is not a good sign. Number 4 ratio is debt to equity ratio. The debt to equity ratio is a measure of company's debt in relation to its equity. It indicates the degree to which its operations are funded by debt and whether shareholders' equity can cover total liabilities of the company. Debt to equity ratio is calculated by dividing the total liabilities by total shareholders' equity, and a value greater than 1 indicates that the company has more debt, whereas a value below 1 indicates the company has less debt. So what can be considered a good debt to equity ratio? Because capital structures, industries and other variables can all influence the interpretation of the debt to equity ratio, a higher value isn't always a bad sign. So this important financial ratio should be used in conjunction with other metrics to gauge a company's financial health. For example, here we can see that the debt to equity ratio of Bharti Airtel is 2.99, which is not a good sign as it is neither a bank nor an NBFC. So the fifth ratio is price to earning ratio. The price to earning ratio or PE ratio is a common financial ratio that measures a company's share price in relation to its earning per share. In other words, it is the amount an investor must pay for each rupee of earnings. It indicates whether the market price of a stock reflects the company's earning potential or true value, and it helps investor determine if the stock is undervalued or overvalued. P/E ratio is calculated by dividing a company's price per share by its earning per share. So what is a good P/E ratio? Since this metric varies between industries, there is no benchmark for what makes a good P/E ratio. That said, a relatively high price to earning ratio can indicate that the stock is overvalued or that is expected to have significant future earning growth. On the other hand, a low P/E ratio can indicate that either the stock is undervalued or the expectations are low. For example, here we can see that the P/E ratio of Adani Green Energy is 129 along with a high debt to equity ratio of 7.42 makes the stock overvalued. Ratio number 6 and the last one for today is dividend yield. Dividend yield is an important financial ratio that measures of a company's annual dividend payouts relative to its stock price. Expressed as a percentage, it indicates the value of dividend payouts the shareholders receive for each rupee of the company's stock that they own. For investors who prioritize dividend payouts over capital gains, dividend yield is a way of measuring return on investment. The dividend yield is calculated by dividing dividend per share by share price, then multiplying by 100. So what exactly is a good dividend yield? A higher number indicates a larger value of dividend payouts relative to its share price, whereas a low number indicates a smaller value of dividend payouts relative to its share price. As averages can vary between companies and industries, a dividend yield between 3% to 5% is generally considered good. For example, here we can see that the dividend yield of Indian Oil Corporation Limited is 10%, which is exceptional. While these are the most important financial ratios to analyze a company, they are just a tip of the iceberg. There are a number of other ratios and key metrics that we need to take care of while selecting a share to invest. We will have a look at some of the other important ratios in the part 2 of this fundamental analysis series. I hope you guys found this video useful and learned something new about selecting a stock before we invest our money. Do not forget to like, share and subscribe to the channel. I will meet you in the next video. Till then, take care.